Ladies and gentlemen, I hope you enjoyed your lunch. Please join me in welcoming our webcast viewers. My name, again, is Andrew Graham. I'm president of the Canadian Club of Toronto and your host today. Viewers, thank you for joining us. Whether you join in person or online, we're really proud of our club's track record of attracting terrific speakers. The Canadian Club is 122 years old, and it's become a true institution, I think, in this country. And we're going to hear, I'm sure, about disruption and change. And I think a number of years ago, we could have been worried about the fate of an institution like ours that does something kind of old-fashioned, which is has people come in person and have lunch and listen to a speaker. I think there's lots of people could have said, well, is that going to survive the era of Twitter and the internet? And I think the very happy answer, and the answer that all of you are sort of demonstrating by being here, is that there's absolutely an important place for in-person conversation and in-person dialogue. At this time, I'd like to acknowledge the generous support of today's sponsors: Borden Ladner Gervais, BLG, represented by Lynn McGrade; BMO, represented by Cameron Fowler; and DBRS, represented by Doug Turnbull. We couldn't do this without you. Thank you. I mentioned earlier that it was a busy week for us at the Canadian Club. We had Rana Sarkar, the Consul General for Canada from Silicon Valley, or in Silicon Valley. We had the president of Peloton, which is a groundbreaking fitness company. And now we've got Mr. Wiseman here with us today. And I think as different as those three speakers may seem, I think there's a common thread that will link them all, and that's the thread of disruption and how the world is changing. The idea of having Mark come back and speak with us really, I think, came from the fall when we, Colleen Kennedy, our executive director, and I were reading a op-ed that Mark had published in the FT where he talked about the future of asset management. And I was struck by the tone. He said, if you're unlikely to evolve, you're likely to get eaten. And for someone in a field that may be one of the more, or maybe viewed as one of the more unchanging parts of the financial services landscape, I think it was really a provocative way to start an op-ed, and I'm looking forward to hearing his thoughts as he builds on that today. We all know Blackrock. It is $6.4 trillion of assets under management, considered the world's largest asset manager with clients in more than 100 countries. Mark serves as global head of active equities for Blackrock and chairs Blackrock Alternative Investors. Mark has been at Blackrock for 3 years. He joined from the Canadian Pension Plan Investment Board, where he was president and CEO, and he was there for 4 years in that role and held other senior positions before getting that job. Mark's impressive investment career also includes overseeing the private equity fund and co-investment program at Ontario Teachers' Pension Plan. He's a member of the Advisory Council on Economic Growth, which advises the Canadian Finance Minister on economic policies. He also chairs Focusing Capital on the Long Term, which is an initiative he co-founded. Mark also finds time to serve on several boards, including Sinai Health Services, the Dean's Advisory Board of U of T Rotman School of Management. Joining Mr. Wiseman in conversation is Jackie McNish, a Toronto-based senior correspondent with the Wall Street Journal. She's been a business journalist for more than 30 years. Jackie is the winner of 9 National Newspaper Awards and 3 National Book Awards. She is also an adjunct professor at Osgoode Hall Law School. Mark and Jackie, I'm pleased to pass the Canadian Club of Toronto's podium over to the two of you.
Are we working? We're working. Good afternoon, everyone. Mark confided in me before we got together that he went to Davos a day earlier, and he did exactly what you wouldn't expect from an investment fund manager. And you want to share that inside information with his crew?
I did skeleton racing.
Head first.
But I didn't crash, so it suggests I'm good at risk management. It's all about taking risks. It's all about taking risk in a calculated fashion.
So there were 8 of you, and how many of them crashed out?
Three broke bones. But it was just I took a steady approach. For those of you who don't know, there's a famous sort of bobsled and skeleton run in San Moritz, Switzerland, called the Cresta Run, which was where the sport was invented. And one of my colleagues at Blackrock, one of the things being part of a diverse international organization, you meet lots of interesting people. And one of my very senior colleagues is actually a master skeleton racer, and he was determined to teach me his sport. So anyway, I'm here
In one piece.
I'm here in one piece.
All right. Well, we're glad you are. Big takeaways. It was a big year for Davos. What were the takeaways for you?
Well, it was a very interesting time at the World Economic Forum. I'm very privileged to be able to go to Davos. This was my 11th year of the last 12 being able to participate, and everything people hear about it is true. It is elitist. It is the wealthiest in the world talking about problems that by and large don't affect them. It is corporatized, et cetera, et cetera. But it is, in spite of all of that, an amazing place to open your mind and be able to have discussions with some of the most fantastic and interesting people around. I think this year was quite different. And it was quite different in many respects because of who was not there. This year there was no Trump, no Xi, no, I heard Trump couldn't come because he was only able to fly commercial. No Theresa May, no Macron, no Modi, no Trudeau. And as a result of that, there was actually more oxygen left to have real discussions about business. And so it was a quieter World Economic Forum. There was just less traffic, less security. But in fact, in many respects, I found the business discussions to be richer. The other thing I would say is that the mood was, and I choose my words carefully, less pessimistic than one would have anticipated, given all the things that are going on in the world. When you spoke to business leaders about their businesses, they were quite optimistic. Increased revenues, increased profitability, backlogs, being able to, by and large, protect margins. Didn't see a lot of inflationary pressure. So as you got into those individual discussions, I will say it felt a lot less pessimistic than maybe if you're spending your time reading the Wall Street Journal, for example.
Your point would be. But what's different about now for investors, for journalists, for business people is geopolitics. They have entered into the domain of business decision-making and investment decision-making in a way that I've certainly never seen in my career. We have a senior executive from Huawei wearing a GPS ring around her ankle in Vancouver. We've got Carlos Ghosn in a jail in Japan. And this has created enormous volatility. It's opaque, it's confusing, and it's not pessimistic, but it's different. And is this the new normal, do you think?
I think it is potentially the new normal, and I think it means that investors have to think somewhat differently. But I'm generally a glass half full type of guy. I'm from an investor's point of view, I think this is a great time to be an investor. We've been in a period of time over the last, let's call it 7 to 8 years, where most outcomes have been driven, frankly, by monetary policy. And so, the way I describe it in simplest terms, investing is really about forecasting future cash flows. So whether you're pricing a bond, whether you're buying a piece of real estate, where's Blake, whether you're buying a public equity, a private equity, et cetera, it's all kind of the same thing. You are trying to probability weight future cash flows and then discount those cash flows back to the present. Now, when the discount rate is 0 or almost 0, what becomes most important in that equation, that net present value equation, is any change in the discount rate. So if discount rate's 0 and it goes up by 25 basis points, it has a huge impact on net present value. In fact, a much bigger impact than what those future cash flows are going to be. And so we've been in a period of time where for the active investor, in whatever type of active investing you're doing, has had a very, very hard time adding value to portfolios, because in some respects, the tides are so big that the waves on top don't matter that much. Now, and I would say this really started in the fourth quarter, we've had a period of reflation, so those interest rate moves are less sensitive to the equation. And we've had a lot of babies thrown out with the bathwater in the fourth quarter as the market adjusted. And there's volatility in the world. Well, guess what? That's what investors should look forward to. And, as an investor, and I see, lots of my former colleagues from CPPIB in the room, I see colleagues from across the industry, this is the time that we should have a view. This is the time that, and it's, whether you're using systematic means or fundamental means, this is the time where we can actually add value from active management. Now, we have to do that very differently than, to your point, than we've done it in the past. We have to use more technology, and we have to learn a lot more and have a view on things that we're not used to pricing, like geopolitics and what someone might tweet overnight. But I look at that as an opportunity to actually participate in markets and find a way to generate that all-elusive alpha in portfolios.
And as head of as senior executive of a very large fund, you have the ability to think long-term, to get through that volatility.
Well, we have probably less ability to do it than my former institution. And that's one of the things that, is quite a bit different. And we were talking a little bit on the lunch table about flows and how fast capital flows. And we're sort of at the epicenter at Blackrock of capital flows. And so I think that ability to be long-term, the advantage of being long-term, is more important today than it ever has been, because you have to look through all the nonsense and the noise and the tweets. And if you have the ability to do that, I think that you can actually generate a lot of excess value and excess return, because guess what? Markets mean revert. Right? Markets mean revert. You have all kinds of terrible things that happen in the world, and markets mean revert. I will, go back to 9/11. Just let's think about that terrible incident. It wasn't that long ago. And we said, things will never be the same. We had horrible, not just the human cost, but we had horrible economic cost. And guess what? There was regeneration. There was regrowth. New York came back, markets came back, the U.S. came back. And so if you can take that long-term view and are able to look through the cycle and look through geopolitical events, you can actually generate a lot of value in the long run. And I think, one of the brilliant design elements of the Canadian pension institutions is that they're able to do that in a way that is much different than almost any other investor. At Blackrock, we're trying to replicate that in terms of the types of products that we're offering to clients. Many of you guys have written about it, our new long-term private capital fund that we're about to launch. And so I think that this ability to fight against the short-termism that we are seeing as being more and more pervasive in the world allows one to generate more value. I just had this fight on CNBC last week.
Did you win?
I don't know if anybody saw it, but Joe Kernan asked me at Davos. He said, it's really hard to be long-term in these markets, and he said, I don't want to invest beyond 2 years. And I looked at him and I said, why? Like, are you going to die? I mean, if you don't think you're going to die, you should be longer term. So I really think, and this is something that, as you know, and I see Alison Lote, my colleague from Focusing Capital in the long term, this is something that I've been talking about for a long time, which is that we need as investors, as asset managers, as asset owners, as managers of companies, to actually try and get ourselves away from this short-term thinking. There was a study done a couple years ago of S&P 500 companies that said, CFOs of those companies, and 55% of them said that they would forego an NPV positive investment if they were going to miss quarterly earnings by just 1 penny. They basically admitted that they were willing to destroy shareholder value in order. That's crazy. That's crazy. And if you think about it, all the money in the world almost all the money in the world is long-term in nature because the money belongs, every dollar, every yen, every renminbi, every pound, every euro belongs ultimately to individuals. And those individuals save that money. Saving, by definition, is a long-term proposition. You save money to put your kids in school, to buy a house, to retire for future generations of your family, to be philanthropic, whatever. But those things tend to be reasonably long-term. And something's wrong in the system where you then give your money to an asset manager, whether it's a financial advisor, a mutual fund, a pension fund, that asset manager then allocates that money to a corporation. That corporation is governed by a board of directors, and then the capital is allocated to projects, and if it all goes well, you get that capital back in some return through the system. Something's wrong because the person whose money it is long-term. And yet the decisions being made by our corporations today are like for the next 90 days. It's crazy.
So part of the consequences of what you're talking about is that we're seeing fewer companies list publicly. That's one of many factors. And we're seeing the number of listings decline. We're seeing companies, whether they're technology startups or family-owned businesses, moving on to the next generation. They're going to private money increasingly. Now, how does that trend affect the fund industry?
So this is a massive trend. Just to put a few facts that, because I've been looking at this very closely. Today there's approximately 3,900 public companies. 20 years ago there were 7,500 public companies. Not only that, the number of physical securities outstanding is decreasing because with share buybacks, just the inventory of securities isn't there. And we just did an institutional survey where we surveyed 1,900 Blackrock institutional clients. 37% said they were going to, well, actually 47%, 10% said they were going to decrease, 47% said they were going to increase their allocation to private equity in the next year. So institutional investors are seeing this, and it means that we as asset managers, both for institutional investors and ultimately for high net worth and retail investors, have to figure out how we can give better access to our clients to those risk premia in private markets. And so for us, we've got a huge growth objective in terms of building our alternatives platform. People don't think about Blackrock and alternatives, but we're today the 6th largest.
And by alternatives, you mean?
So private equity, infrastructure, real estate, private credit, hedge funds. That's sort of broadly how we describe it.
So I want to pivot a bit and talk about technology. Your CEO, Larry Fink, recently said he aims to generate a third of the revenue through technology. That's a very ambitious goal. Tell us what that technology is and what advantage you have given the size of your funds to do this.
So what Larry's referring to in that discussion is our Aladdin system. And our Aladdin system is a system that was developed by Blackrock over the last couple of decades that basically manages all of our activities inside the firm. And the stroke of genius as it relates to Aladdin, and this is all long before my time at Blackrock, but the stroke of genius as it relates to Aladdin was to actually start selling our system to first our clients and then our competitors. And so today, BlackRock's $6+ trillion of AUM uses the Aladdin system, but there is a significant multiple of that AUM on the system, third parties, including some of our biggest competitors that are using the Aladdin system. So for BlackRock, it has become a major portion of our revenue and earnings, and I think we believe as we continue to improve the system and as our clients continue to improve the system, because there's increasingly open architecture on that system, that will be a bigger and bigger business for us.
So let's talk a little bit about what exactly Aladdin is. It's your, in probably massively overgeneralizing, but you're taking all your risk analytics and data analytics and parlaying that into what for your customers?
Well, first of all, it's a system we use. So most importantly, it's what we use. So it's an end-to-end system that does everything from managing your order entry in public markets, allowing you to measure all the various risks in your portfolios, creating management reports, creating client reports, and then tying it all together in a way that you can have all the information you would want at your fingertips. So the beauty of the system is that it's kind of been ahead of its time because it integrates all of the aspects of what we do. And again, it's what's allowed BlackRock to grow to the scale that it's been able to grow at, because we can operate at scale, we can reduce costs as a result of using the system, and then of course the system itself has become a source of revenue generation for the firm as we sell it and services related to it to third parties. And as Larry said, we think it will, in the medium term, represent as much as a third of our revenues and profitability. So it's sort of, but I think one thing that people miss is having that technologically enabled mindset in the organization is the most important thing. So what it really does is allows us in every part of what we do to utilize technology in a very nimble, quick and efficient way. So for me, having responsibility for our investment programs, and Andrew referred to the article in the FT, that sort of lesser paper. What we're doing is being able to integrate very, very quickly and easily things like AI, big data, machine learning into our investment processes. So Aladdin starts as an operating system, but what it really does for the organization is creates a state of mind.
So we're sitting here 2 weeks after the death of Jack Bogle, who's the father of index funds. It feels very much like the whole world of fund asset management is poised for a fairly disruptive period. If you were to look out 10 years from now, what would you tell the audience about what they should expect in terms of fund management, the industry in general?
It's a good time to be a consumer. And I think that our industry is, and ETFs is pun intended, have been the vanguard of that. But that is going to roll through the whole industry. And so just think about the way that technology is disrupting every single other business out there. As it disrupts business, there's a number of common things that take place. First of all, by and large, the consumer is the winner. Because there's transparency, there's efficiency of delivery, et cetera, et cetera. Think about what's happened purchasing something as simple as an airline ticket. Right? Airline tickets today are about 6% cheaper, adjusted for inflation, et cetera, than they were 10 years ago. And yet the margins of the airlines are up. So why is that? It's because the system has become more efficient. We have disintermediated the travel agent, right? You can't even find a travel agent today. Right? It wasn't that long ago that we, had those paper tickets with the red carbon stuff on the back, right? Some of us remember that. And today, it all happens on your phone. And that entire productivity gain, all of that efficiency, the winner is the consumer. The consumer has captured the economic rent from that productivity gain, the most of it. And that's going to happen industry by industry by industry. And in asset management, what it means, and we've seen it in ETFs. What's happened with ETFs? Through scale, through technology, consumers and institutions are now able to get access to beta unbelievably efficiently, almost for free. And so with that, the pressure's now on all the other aspects of asset management. So if you think about it, what being able to get access to beta very efficiently does is it doesn't raise the bar for active management, it lowers the floor of the whole stadium. And so as a result, the industry's got to figure out how to be able to deliver end-to-end to clients different forms of products that will add value at smaller and smaller cost. And that's a great thing for the consumer. And it comes through distribution, it comes through the cost of active management, it comes through administration fees. And so all of this pressure is going to come from technology affecting our industry. And by the way, Canada, and I'm looking at Cam, I've got to be careful what I say, but Canada has been behind, right? Canada's been behind. The Canadian consumer in asset management is still paying way, way too much for investment products. But it will come here too. And I want to make one other point that I think is really important, and it's really important for us as Canadians, is in all of these industries that are being disrupted by technology, scale matters. Because you need to be able to spread your cost over a larger and larger base. So Amazon wins, Google wins, Netflix wins, Alibaba wins, Expedia wins. And so we've got to keep in mind that in every single industry that has been disrupted by technology, the winners are the scale players or the very specialized boutiques. So if you're a retailer, you better be Amazon or you better be selling scented candles from your, craft store in Vermont. But everybody in between, Jen likes that, right? It's an inside joke. Everybody in between is going to get squeezed. And so I'm, of course, talking my own book a little bit at Blackrock, given our scale. But what we're doing in terms of implementing technology, the cost of that platform, we have to be able to spread that over massive AUM in order to win. Now, this is my point that I think is incredibly important for Canadians to understand. We don't have scale. One of the biggest things that I discovered moving from Canada to the US is the definition of scale. And in this country, unless our businesses expand outside of our borders, we are doomed. Because we don't have enough scale in this country to compete. And so the Canadian winners have to be global because they have to be able to access the scale of global markets. So for me, that's one of the biggest eye-openers of the last 2.5 years working at a huge organization with Blackrock, which, by the way, operates in with 87 offices in 37 countries, managing money for literally hundreds of thousands of clients. Scale, that's scale. I had a discussion with George Cope on the same topic. You think about as big as Bell is in the Canadian context. I don't know what Bell's up to today in terms of active mobile users. It's probably 5-8 million, something like that. There are 45 million mobile users in the city of Beijing. Right? How do we compete with that? We've got to figure that out as a country.
Okay, we're going to move to questions, and if you've got a burning question, raise your hand and we'll bring the card up here. Segueing from what you just said, someone wants to know what your current view of Canada is in the eyes of global business and political leaders in terms of how we execute our decisions, a place to invest, and our ongoing transition to more of a technology-based economy.
So I think Canada is actually in a pretty good spot right now, and the question is, how are we going to take advantage of the spot that we're in? I mean, if you if you think about it, Europe's got a couple issues going on. The U.S. has managed to isolate itself. In spite of recent issues, we've tended to have fairly good relationships with Asia and with Europe and with the U.S. So I think Canada is actually in a very unique position right now to actually expand its presence on the global stage, both from a political point of view and from a business point of view. I would say the only thing I would say about that is that we ought not to be naive in terms of how we pursue it. So we have to keep in mind who we are. I think we are, again, from a business point of view, or from a geopolitical point of view, we are kind of just barely a middle power. And so I think we need to just recognize that as we pursue our ends. But I think if we recognize that and play our cards right, we're in an unbelievably good position. I'm going to make one other plug, which I also believe, though, we have to continue to be conscious of the scale issue. And we are actually, if we're not very, very thoughtful, shrinking as a country. We don't realize it yet, but we are shrinking. And this is
shrinking by what measure?
population.
Okay.
And we don't realize it yet because we don't see it day to day, and it takes a while to play out. But this is a project that Dominic Barton and I and Tom Milroy, Goldie Hyder, and several others have been involved in something called the Century Initiative, which is actually with a goal of getting Canada to a population of we've spoken to the Canadian Club before about this, getting a population of 100 million by 2100. And I think that's critically important because we won't be if we're not there, we won't even be a middle power. And so with a birth rate of 1.55, okay, that means we shrink. It means we're shrinking. We will grow with current immigration levels to about 50 million people in this country by 2050, and then we stop. And then we stop. So unless we address this issue by, among other things, increasing immigration, increasing the ability of women to succeed in the workforce by creating things like National Child Care Program, by focusing on our education system, we are going to see that sort of barely hanging on middle power status. By the time our children are sitting on this stage or sitting in this audience, it'll be a very, very different discussion. And so the scale point is important today, but it's going to be even more important in the decades to come.
All right, we probably only have time for one more question.
If I keep talking, it's great.
Okay. People will
Don't have
just
to answer any
quietly slip
questions,
away.
exactly.
I love this question. What is the best advice you were ever given, and how has it helped your career? Don't go down the skeleton.
I was going to say, keep your head up when going in the corner. No, look, I think probably the best advice I've been given. I've really had the privilege in my career to work with some amazing people, and I don't think there's a specific piece of advice, but I've often thought about what made those people amazing. So I had a chance early in my career as a young lawyer to work with Beverly McLaughlin at Ontario Teachers. I got to work with Claude Lamoureux and Jim Leach. My predecessor at CPPIB, David Dennison, and now Larry, have all sort of helped me along in my career. And I think they have three things in common, and I'll do this quite quickly. All very different styles, different businesses, very different people. First is they always kept their promises. And I think it's really, really important as a leader to keep your promises. So, and if you can't deliver on something, don't promise to do it. If you make a promise, make sure you deliver. And they all taught me that. Secondly, to be predictable. I don't think you have to agree with the leader's decisions all the time, but you want him or her to be predictable in their decision making and build up a body of precedent. And I try and do that in my career. And third is to make sure that you don't undermine the people on your team. They've got a job to do, you've got a job to do, and understand and let them do their job, and they should let you do your job. And I think all the leaders I've worked for have sort of ingrained that in me, and I'm not necessarily as successful as they are at embodying it, but I think that advice is, I don't know if that's advice, but it's sort of collective wisdom has really stuck with me.
All right, pretty good advice, folks. Thank you very much, Mark.
Thank you. Thank you, Mark and Jackie. Hello, everyone. My name is Colleen Kennedy, and I have the privilege of being the Executive Director of the Canadian Club of Toronto. And I also had the distinct pleasure of going to Queen's University with Mark, where I think our organization of Frosh Week in 1990 really set him on the asset management path.
I meant to bring the picture of me and Colleen, who were co-organizers of the never forgotten 1990 Queen's Frosh Week.
Yes, where he claims to be the first person to monetize Frosh Week and get it sponsored. So, you're welcome, Queens. So, Mark, on behalf of the Canadian Club of Toronto, I'd like to thank you for sharing your enlightened insights with us this afternoon. Your deep knowledge and experience in asset management served our audience well. In a time when market volatility is the norm and not the exception, we can be tempted to quit the markets altogether. Your defense of investing for the long term makes good sense. Quite frankly, it's hard to argue with an expert whose company has trillions of dollars in asset management and who's Canadian to boot. So congratulations. Please accept our best wishes for ongoing success no matter where the market goes. So thank you again. And to you, Jackie, we appreciate you sharing your insights and your journalistic expertise to move this conversation along. Thank you very much. Before we conclude, just some highlights of upcoming events. Next Tuesday, we have a cannabis panel talking about the outlook for cannabis in Canada in 2019. With the,
Man, it's mellow.
That's right. And then on the 8th is Murad Al-Khatib, the CEO of AGT Food and Food Enterprises, talking about pulses in Canada, and how Canada can lead agricultural development in the whole world. And of course, we hope you all can attend that. I would like to...
Can I say something about this guy, just for a second? You got to come see this guy. This guy is the lentil lord. And he actually is going to change. So we want to talk about a Canadian who's scaled. Nobody's heard of him. You've got to come and listen to this guy about what he's done in terms of delivering Canadian lentils to the world. It's an amazing story.
Thank you. I really appreciate the plug. We'd love to see as many people as have come to see you. So I also like to thank again BMO, BLG, and DBRS for being our sponsors today, and MediaEvents.ca and VVC for live streaming today's event. If you want to check out the podcast or the web stream, it's all there on our site, and the pictures from today. Thank you for being with us. We hope to see you again, and please stay warm out there. Thank you.